Good morning, friends. It is a pleasure to dive into these high level financial strategies with you. Since you are looking for a blend of advanced options trading and long term equity growth, I have structured this guide to help you navigate the US market with clarity. Part 1, this covered ratio spread strategy. The covered ratio spread, also known as a covered combination, is a sophisticated strategy used by investors who already own a stock and want to generate extra income or lower their break-even point while maintaining a neutral to moderately bullish outlook. Step-by-step trading process. Own the underlying assets. You must already own 100 shares of your US stock, e.g. AAPL or MSFT. Sell 2 out of the money. That means OTM. Call. Sell 2 call options at a strike price above the current market price. Strike A. Buy 1 further OTM call by 1 call option at a even higher strike price. Strike B. Net credit or debit. Ideally, you execute this for a net credit, meaning you receive money upfront. How to get minimum consistent profit. The sweet spot your maximum profit occurs if the stock price is exactly at strike A. The short calls upon expiration. All options expire worthless and you keep the premium plus the stock's capital appreciation. Safety buffer because you own the stock, one of your short calls is covered. The second short call is protected by the long call you bought at strike B. This limits your naked upside risk compared to a standard ratio spread. Minimum profit strategy. Focus on stocks with low volatility. If the stock stays flat or moves up slightly, you pocket the theta time decay of the options you sold. Part 2. 5 growth equity stocks for 2026. To find the stocks with strong fundamentals plus government support and strategic acquisition, we look at sectors like defense, AI infrastructures, and green energy. 1. Lockheed Martin, that means LMT share. Growth driver has the US government largest contractor. LMT has massive government support via the Department of Defense. Acquisitions or tech. They consistently acquire niche firms in hypersonic and AI to maintain their lead in the F-35 program. Growth logic, geopolitical stability requirements ensure a wide moat and multi-year order backlogs. Number 2, company Microsoft. MSFT. Growth driver dominates the AI space through its partnership investment in OpenAI. Government support. Azure is a primary cloud provider for US government agencies, JEDI or JWCC contracts, acquisitions known for massive moves like Activision, Blizzard to integrate ecosystem and capture data. Third one company is Aero Environment, that means AVAV, growth driver specialization in robotic system and concave drones, switchblade used heavily in modern warfare. Government support beneficiary of the replicator initiative aimed at scaling small cheap autonomous system. Acquisitions recently acquired Blue Halo 2025 2026 to expand into space and directed energy weapons. Fourth, Amazon AMZN, growth driver AWS, cloud and high margin advertising. Government support like Microsoft, Amazon is a core provider for US national security cloud infrastructure. Acquisitions. Their acquisitions of one medical and iRobot, those scrutinized, shows their intent to own the smart home and healthcare data vertical. Fifth company, Micron Technology, MU short form, growth driver essential for the AI hardware boom. Government support as beneficiary of the CHIPS Act, receiving billions in grants or loans to build US based semiconductor plants. Growth logic, they are reshoring manufacturing to the USA, making them a strategic national asset. Great, let's pick a concrete example to see how the numbers actually play out. Since Micron Technology, that means MU, is a major beneficiary of the CHIPS Act and has clear growth triggers, it is a perfect candidate for a covered ratio spread. Example, Micron MU covered ratio spread. Assume MU is currently trading at $100. The setup ownership, you own $100 shares of MO at $100. The spread options. Sell 2 calls at the $110 strike price, strike A. Let's say you collect $4.00 each, 8.00 total. Buy one call at the $115 strike price. Strike B, let's say this cost you 2.50 cents. Net credit, you pocket a total of 5.50 cent dollar. That means $550 per contract set immediately. Outcome scenarios. Example, let stock price and result below 110. You keep your 100 shares plus the 5.50 cent credit. Your break even on the stock drops to 94.50 cents. At maximum profit, you keep the result stock price. exactly $110. $5.50 credit plus $10 gain on the stock. Total profit 15.50 cents. That means $1,550. At $150, you sell 100 shares at $110, forced by one short call. The second short call is now $5 in the money, but your long call is at the strike. You still profit from the initial credit. Above $115, the long call caps the loss on your second control call. You are effectively flat on the options, but keep the stock gains and the initial credit. Why this works for growth stocks income while waiting. If the stock consolidates, moves sideways after an acquisition or a government grant announcement, you get paid to wait downside protection. The $5.50 you collected acts as a cushion if the stock dips slightly. Controlled upside, you are essentially saying, I am happy to sell my shares if they go up 10%, and I will use the extra rent from the second call to buy insurance, the long call. Please like, share, subscribe and comment this video. And now I am introduced to my website. www.noblestores.shop. This is only online affiliated Amazon shop. I selected special and important products. Whatever you purchase, small commission I get from Amazon. Thanks friends. Once again I will thank you. Please visit my website and find out what is what product. Once again I will thank you. And my another video is there, that is 45 minutes 45 seconds. Listen.
In 2026, the U.S. market strategy continues to recognize covered ratio spreads as a valuable tool for seasoned options traders. This complex strategy allows investors to manage risk and seek additional income, though it remains best suited for those with advanced market knowledge. Meanwhile, high-growth equities have shown mixed results amid ongoing market volatility. Sectors like technology and renewable energy stand out, with certain companies posting strong earnings and expanding market share. However, these high-growth stocks also face hurdles, including regulatory changes and increased competition, underscoring the importance of careful analysis before investing.
And this is the mine. Creators with the creators. They are Google has subscribed and their channel is Grow Upside. Please subscribe and grow your channel. And this is mine. Please like, share, subscribe and comment. We will meet next video. Once again, thank you very much, friends.